I'm so sorry, ma'am. I know you need this medicine, but it looks like it's not covered by your insurance.
Yeah, unfortunately, I had to deny that one.
Wait, who are you?
I'm your insurance company's pharmacy benefit manager. I get paid based on the price of a medicine, and I don't make as much money off this one.
No one should stand between you and your medicine. Visit phrma.org/middleman to learn more. Paid for by Pharma.
If you are a lover of affirmations or you've just heard about how powerful they can be, then you are going to love the Daily Affirmations for Women podcast, created by the Women's Meditation Network and hosted by the amazing Jodi Agard. Every morning you'll receive an episode that is dedicated to one specific affirmation, so you can have the space to reflect on it and receive the power within it. Follow and start listening now to the Daily Affirmations for Women podcast on your favorite podcast player.
This is Optimal Finance Daily, episode 2432, The Mistake People Make When Investing, by Chris Reining of chrisreining.com. And I'm your host and personal finance enthusiast, Diana Merriam. We're going to jump right into today's post as we optimize your life. The Mistake People Make When Investing, by Chris Reining of chrisreining.com. I'm listening to my dad's funeral service. He was killed riding his motorcycle 10 years ago. Witnesses said he was going 40 miles per hour and a 19-year-old waitress driving an SUV didn't yield on a left turn. He ended up face down on the pavement. She was charged with criminally negligent homicide. I know all of that because I emailed the police department to get the report. I didn't go to his funeral because we hadn't spoken in 12 years. I regret not going. My aunt, his sister, sent me a CD of the service. I ripped it to an MP3 so I could store it on my iPod and listen to it every year on the day he died. Maybe the best thing he taught me was how important investing was. Because when I was a kid, he bought me a single share of Wrigley stock. I thought it was cool because every Christmas they'd send me a free box of gum, probably why he chose it. Anyways, every day I'd check the stock price in the newspaper to see if I made money. I loved it. I didn't really know anything about investing then, but I learned it was a way I could grow my money. Then my parents were getting a divorce. He was moving to a different state. It was messy. I remember him telling me in the basement, "You're going to be the man of the house now." He showed me how to put salt in the water softener. I think I was 15 or 16. I don't remember very much about that time. I went to college and spent my time partying. I got nearly straight A's most of the time, but I was miserable. I graduated and took a job at a tech startup. It paid $36,000. I started investing $66 a month because that's all I could afford. I put it in an S&P 500 index fund. The Clintons have all their money in an S&P 500 index fund. Shouldn't they be paying a team of financial advisors to tell them what to do? I guess not. They should tell Donald Trump he'd be richer if he invested in index funds. In 1978, he was worth $100 million. If he put that money in an index fund, he'd be worth $6 billion based on the annual return since 1978 of 11.61%. Instead, he only has $3 billion. Oh well. Over the short term, you don't always make money investing though. That's why it can feel scary. I lost a lot during the recession. In 9 months, my portfolio went from $175,000 to $120,000. And I was thinking I should have sold everything when I had the chance. But I knew that over the long term, the market always goes up. So as delusional as it felt, I kept on investing. And looking back, it's hard to spot where the recession was. Warren Buffett says, investing is simple, but it's not easy. And that's true. You can put all of your money in index funds. That's simple. Then you have to do nothing. That's hard. Do you remember in early 2016 when the S&P 500 lost more than 10%? People got scared and they sold, but the market rebounded, and that's when they get back in. Buy high and sell low. The mistake most investors make is not knowing how they're going to react when the market goes down. So what you can do is figure out how much risk you can tolerate and then invest your money appropriately between stocks and bonds. If you can tolerate more risk, you invest a larger percentage in stocks. Less risk, you do the opposite and invest more in bonds. This is something called asset allocation, and one of the best books about it is The Intelligent Asset Allocator by William Bernstein. There's a chart in that book that says if you can tolerate losing 35% of your portfolio, but earn higher returns over the long term, then invest 80% in stocks and 20% in bonds. And if you can tolerate losing 20%, invest 50% in stocks and 50% in bonds. And if you can tolerate losing just 5%, then invest 20% in stocks and 80% in bonds. That's all you really need to know. What you're doing with asset allocation is managing risk. Yes, you'll still feel scared when the market goes down and you're losing money. That's natural. But you'll be less likely to react and ironically end up doing a risky thing, like selling at the worst possible time. You just listened to the post titled The Mistake People Make When Investing by Chris Reining of chrisreining.com.
I'm so sorry, ma'am. I know you need this medicine, but it looks like it's not covered by your insurance.
Yeah, unfortunately, I had to deny that one.
Wait, who are you?
I'm your insurance company's pharmacy benefit manager. I get paid based on the price of a medicine, and I don't make as much money off this one.
No one should stand between you and your medicine. Visit phrma.org/middleman to learn more. Paid for by Pharma.
This episode is brought to you by Shopify. No matter how big you want to grow, Shopify gives you everything you need to take your business to the next level. Shopify is the commerce platform that makes it easy to show up and sell exactly the way you want to. No need to code or design. Sign up for your $1 per month trial period today. Visit shopify.com/offer23 to get started.
This article is a great reminder that when we invest in the stock market, we're signing up for a roller coaster ride. When the roller coaster starts its downward spiral and everyone around us is screaming and freaking out, the worst thing we can do is unbuckle our seatbelt and jump off. And most of us wouldn't do that on an actual roller coaster, right? Because we got on the ride knowing that there were going to be ups and downs. We need to get on the stock market ride with the same knowledge. There will be ups and downs. But if we stay on, we can enjoy the wind in our hair on the way to financial freedom. Because the market always goes up, always. Not over the course of any 1 month, day, or year, but over the long term, it goes up. And in the many years you will be an investor, you should expect some big crashes and recoveries. While the media will say, oh, but it's different this time. We're all headed for financial ruin. That's like saying on the roller coaster's descent, it's just going to crash horribly into the earth and we're all going to die. Is that possible? Sure. But if it did, we're all dead anyway. And in the financial sense, it's not going to matter if you invested your money in stocks or stuffed it in your mattress. It'll be worthless. So even in the absolute worst case scenario, the advice is the same. Stay on the roller coaster. And that'll do it for another edition of Optimal Finance Daily. Thank you so much for subscribing or following the show and sharing it with others. Have a great rest of your day, and I'll see you tomorrow where your optimal life awaits.